Good morning. My name is Jerry DiColo, and I'm the Metro Editor of the Times-Picayune. I want to welcome you to the Times-Picayune and the Advocate's Personal Finance panel, where we'll be speaking with a number of local experts on investments, insurance, and other issues that are important to Louisianans. Before we begin with business reporter Stephanie Riegel, who will be hosting the panel, I'd like to thank our sponsor, AARP, and we'll have a short commercial from them right now.
Welcome to the Advocate's virtual roundtable discussion. I'm Denise Botcher, AARP's State Director. AARP is the nation's largest nonprofit, nonpartisan organization dedicated to empowering people to choose how they live as they age. We work to strengthen communities and advocate for what matters most to families, with a focus on health security, financial stability, and personal fulfillment. Here in Louisiana, we know inflation and the rising cost of insurance, electricity, and prescription drugs have hit your pocketbook hard. AARP works every day to bring common sense solutions to the table so you have a fighting chance to protect your hard-earned finances. Having information about the current economic climate and what's to come is important for families and businesses to protect their finances and plan for the future. I hope you enjoyed today's discussion.
Good morning, I'm Stephanie Riegel, and thank you so much for joining us today. We're so happy to have you here. I'm a business writer here at the Times-Picayune, NOLA.com, and really excited to be able to be discussing these important topics today and hope we can answer your questions and concerns about what's going on in the market, what's going on in the economy, and how that affects your financial situation. Local experts in the banking and financial planning field. Mitchell Bordelon is a certified financial planner and portfolio manager with Crescent Sterling, an independent wealth management firm based in Metairie. Prior to joining the firm, Mitchell spent several years as a financial advisor with Hancock Whitney. He's a native of New Orleans with a finance degree from the University of Southern Mississippi. Paige St. Martin is director of financial planning at Faubourg Private Wealth. She began her career as a financial analyst for a financial planning firm in Baton Rouge after graduating from LSU, and that evolved into a full-time financial planning position by the time she left to join Faubourg in 2018. She has developed an extensive background in holistic financial planning, small business consulting, and fee-based advisory. And Travis Moore, Vice President of Business Banking at Hancock Whitney, with 15 years of banking and financial experience, both at Hancock Whitney, where he has spent the past decade, and before that at Iberia Bank. Travis has a degree in business management from the University of New Orleans and is a native New Orleanian. Welcome, y'all. Thank you so much for being here. And I know there are so many different ways we can approach these topics and so many questions, but I guess just to sort of start out, what is the number one thing you're hearing right now from your clients or your customers in terms of their concerns? And sort of what's the number one thing front on everybody's mind amidst uncertainty with interest rates and insurance rates and inflation and mortgage and not knowing what the feds are going to do? And what are y'all telling them?
Well, I think you highlighted a lot of it. I mean, as clients are coming in there, it's the fear of uncertainty is what we're hearing right now. Will we enter a recession? How high are rates going to go and how long are they going to be there? And so I think we don't know. We don't have that crystal ball. We don't have the answer to a lot of those questions, but focusing on the things that we can control, right? When and how we buy a new home with mortgage rates where they are. How we invest maybe our cash that can yield certain interest rates right now with things where they are. And recession, it's interesting that we're talking today with the Fed having a big decision this afternoon. And hopefully some of their verbiage will give us insight on what the rest of the year looks like.
I think Paige is absolutely right that you can only control what you can control, right? And there is a lot of uncertainty in this point in time. And I think from our clients, it kind of depends upon the client and where they are in their life and what they're concerned about. From our younger clients, they are concerned about interest rates. They're concerned about the mortgage and buying a new home or buying a bigger home. I think some of our older clients are worried about inflation. They're worried about maybe their Social Security, if it's going to go up. It did recently go up with the inflation. and they're worried about maybe their homeowners insurance being too much. And like Paige said, it's doing that proper due diligence. It's, choosing your spots and, yeah.
Yeah, just like they said, right now, as a banker, I'm hearing more of what are the rates going to continue to increase or why are they increasing? And a lot of people don't understand, but a lot of business owners they don't have an option. So they have to utilize those line of credits where those rates are constantly increasing. Mm-hmm. But unfortunately, with the increase, they still have to run their business and manage. So with that being said, they have no other options, but they're more concerned of when these rates are going to stop increasing and, what can we do to combat that?
So I'm just going to throw this out there, and if none of y'all feel comfortable answering it, that's okay. But explain to our viewers maybe how the Fed's monetary policy works. I mean, why do they keep thinking that raising interest rates is a good thing? What's sort of the real simple explanation for how that works?
I mean, I think the simplest way, and I'm certainly not an economist, and please feel free to chime in, but the simplest way is the pressure that we're feeling, right? With inflation where it's at, with the price of goods increasing at such a high clip, as we raise interest rates, that hurts our pocket, right? And so everything comes back to supply and demand. And as long as the demand was still there, the free market had the ability to keep raising the prices of goods. And so once we start tightening our pockets and we feel that in our pocket, we stop buying so much. And so that can freeze or at least slow down the growth of that increase in prices. And so that's the Fed's overarching policy right now is how do we tackle inflation? They have two main mandates. It's jobs and inflation. And so the inflation is the hot topic right now and having to slow that down.
That was very good.
Yes, I think that was great.
Economics 101.
And to piggyback on that, I think his mandate absolutely is inflation, right? It's how do we get inflation to slow down? And we have seen that happening. We've seen it go from, I believe, above 7-8% to now the last print was right around 5% annual inflation rate. So it is working, right? And so I think today, this afternoon, the announcement, you're going to see a 0.25% raise, and there's theories that they're going to pause. And hopefully that is paused because that will be better for everyone's pocketbook, like Paige said. Sorry.
Well, and see what their verbiage is.
Yes.
I think everyone's looking to Fed Chairman Powell to give direction on, is this the pause? And, the market is pricing in a rate cut potentially before year end. I think that might be a little brazen, a little somewhat of an overly positive outlook. And so I think if he can allude, maybe give a little bit more color to what they're having behind closed doors, those discussions that they're having could bring the market and maybe even the American people some peace of mind. Just again, going back to that fear of the unknown. How can we just clear that unknown that the Fed has kind of given us so far?
And one of the big unknowns is, what does he need to see to stop raising? Does he need to see inflation drop below 2%, 3%, or do they just need to see a pattern where this is working and we don't need to continue raising because this inflation is slowly dropping down? So hopefully, like you said, there is going to be some more color. And recently I was at a luncheon with a representative from the Fed from Atlanta and the office based here in New Orleans. Yeah. And they mentioned how they believe that Jerome Powell just needs to see a pattern. He needs to see that, hey, it is coming down slowly or actually fast, and that he doesn't actually need to see that 2% inflation print.
Mm-hmm. So interesting. So, we're talking a lot about interest rates, and that has a direct impact on people's ability to buy homes, finance homes, and their mortgage rates. People's homes are, in many cases, their greatest asset. And with so much pressure right now, we're seeing the value of homes really decreasing. What are you all doing, and what are you all advising your clients with respect to buying real estate, some of the challenges that they may be experiencing?
I know for me, when it comes to, let's say, younger first-time home buyers, it may just be to wait, or it may be to maybe buy down some points in the front end and reduce that rate periodically or do an adjustable rate. For older clients, it may be, once again, just wait. I think in the local market, you're seeing prices come back down to reality. You're seeing it come back down to maybe pre-COVID levels. because out of COVID, you saw this increased demand that kind of brought prices skyrocket and begin to see people, get a lot more value than maybe they otherwise would have for their house. And some people are still in that space. They think that their house is worth a lot more than really what the market's saying it is worth. So I think for some people, it's providing them that second opinion or third opinion that it's, hey, maybe you should wait. Maybe your house isn't worth this, or maybe it's okay to rent right now. There's nothing wrong with renting and waiting, right?
Sure. And I think remembering the true cost of borrowing, when rates were 3-4%, a money market was paying you zero. So your true cost of borrowing, that delta, that difference between what you can earn on your cash and what you can borrow to pay for a home was 3 and 4%. And so now that we're seeing mortgage rates closer to 6.5, 7, well, you can earn 3.5 to even 4.5 in some money market rates. So that delta is still there. And so evaluating how you purchase your home. You alluded to maybe an adjustable rate mortgage when you're at the top of that interest rate curve and it looks like the one way down now, or the direction is down now, taking advantage of a variable rate, or just evaluating how much cash you're putting into this home right now, since your cash can earn 3.5 or maybe even 4%.
Yeah, and as Mitch was saying, it's really unfortunate right now because a lot of first-time home buyers, they don't have many options. And I sit on a board for the New Orleans Housing Services, which is a first-time home buying program. And unfortunately, we're reevaluating our mission because it's not affordable. First-time home buyers do not have to, they don't have the liquidity or the cash to purchase, or they just can't afford the rent. The insurance or the taxes. So we're reevaluating our mission to say, okay, what can we do to continue to be a pillar in the community and also help? But it's just a very unfortunate situation with the increase of rates.
No, I'm so glad you mentioned that. And there are some programs out there, but a lot of times people don't know about them. Or there are programs that help people that are really on the lower end of the income spectrum, but a lot of people in the middle really are squeezed because they might have just a little bit too much in assets, or they might earn just a little bit too much to qualify for some of these super low interest loans. I don't know. But that's a good point that you made, Paige. And what about, where do y'all see mortgage rates going? I mean, do you have any predictions there? And how closely is that tied to the interest rate?
It's a direct reflection of the of
It's
prime.
Like
so unfortunately, as the rates that continue to increase, those mortgage rates are going to continue to increase as well. Right now, I've actually heard someone was quoted like in the 7s on a mortgage loan, which is unheard of. So unfortunately, it will continue to increase as Wall Street prime increases.
What would you say, and Mitchell, you alluded to this, but to the older homeowner who maybe was looking to downsize or liquidate their house? I mean, is this the time, or should they ride it out a little bit longer maybe?
I think there's a couple options. If they are trying to liquidate maybe the equity in their house, you could do maybe a HELOC against the house and pull out the equity that maybe you were looking for. But like Travis said, that a lot of those rates are based on Wall Street prime, which is sitting at around 8% right now, plus the bank's amount that they're going to tack on top of that. So you could be looking at about a 9% rate unless there's an introductory rate. The other idea maybe is to step out of that house and rent it. Or if you do want to just liquidate the house, just bite the bullet and sell it, because there's a good chance the mortgage is paid off and it has appreciated over the last number of years. Then maybe it is time to liquidate. You just won't get as much as you did before. It all kind of depends upon the scenario and the client's objectives, right?
Would y'all agree with that?
Yeah, I think every situation is different, and not looking at the home in a silo, right? Looking at the full financial picture and seeing what other assets they have at their disposal, what other means of lending or borrowing that they may have that could be a short-term bridge loan or just access to capital, and truly looking at their personal balance sheet and seeing what are my best options here, and not just siloing that house out or looking at that mortgage just in it's one piece of a much bigger picture.
And that's Paige, just to piggyback on what Paige was saying, and Mitch as well. Like for us at Hancock Whitney, we actually have an introductory rate of, I believe it's 4.99 for the first 6 months to kind of help alleviate on those higher interest rates on the home equity line of credits. And again, it all depends on the situation that the borrower is going through. So is it the perfect time to sell? Maybe not, but you really have to weigh out your options.
And for instance, something like that 4.99% introductory rate, is that on a conventional loan? And does that apply to anybody, or how does that?
So that's on just a home equity line of credit, which is, them pledging their home as collateral to tap in some equity. It does not apply to conventional loans or first-time mortgages. It's only for existing homeowners.
But at least it's something.
It's something out there. That we can hold
So
on to.
while we're talking about the housing market and real estate, certainly everybody here is really stressing about the insurance rate increases, both property owners, because so many carriers have pulled out of the state, and also what's coming down the pike with the FEMA flood insurance rates. And we've been looking at some of the numbers, and I don't know if y'all saw, we had a map that we ran, and you can look by zip code to see just how much your flood insurance is going to go up, and it's really, really very troubling. What worries me, and I'm not an economist or a banker or a financial planner, but it's the trickle-down effect. I mean, I don't know how the dominoes don't fall. What do y'all see in that arena, and just any advice that you have, again, practical advice for people that are looking to buy or that have these assets? And how do you manage it when all of a sudden your insurance premiums double or triple?
Right. I believe the package that was passed with legislation, what was that, back in January, February, that still hasn't been put into place yet, or some of the out-of-state companies have not taken advantage of those yet. So I know that's one of the things insurance agents are waiting for, is to see some of these companies that may step in with those packages coming into play. I know another thing that some insurance agents are recommending is a wind mitigation test, where you could potentially have a test on your home that can reduce your insurance premiums. But no, insurance premiums are not great right now, and it's a tough pill to stomach, certainly.
It is. And I wish there was some magical piece of advice that we collectively had. I think we're all feeling it. We're feeling it personally, and we're seeing it across our client base. Property and casualty insurance has been an avenue that typically it's a passive approach. Your renewal comes every year, and you just look at it, sign it, great, and the new rate comes into effect. I think that approach is going to change and has to change for the consumer, and being active, talking to your agent every 6 months and saying, has a new company entered the market? Can I reshop this? I think taking an active approach as a consumer is going to serve you. And I think that the landscape is going to be changing with the new legislation, and it's going to be changing rapidly. And so being active as a consumer and shopping it as much as possible.
I think that's a great point, being active with your agent as well, because agents, they have a lot of policies and probably a lot of clients to be dealing with. So sometimes you need to stay on top of your own agent and call them and shop and tell them, I don't want to leave you. I like dealing with you, right? But maybe can we shop this policy around, right? I mean, that's very important. And one other thing I forgot earlier was that the insurance space, it is a free market. So maybe the hope also is that maybe some smaller insurance companies come step in this market and they offer lower premiums and hope to get more policies. But some of those companies have gotten burned in the past, and we've seen through Ida have gone bankrupt and put homeowners in bad positions.
Travis, in the business sector, I mean, certainly investors, even somebody who might own an apartment building, right? And so not only are their premiums going up on their personal property, but on their investment property, which they then have to pass on to the tenant.
Correct.
What are you all seeing among businesses or investors? And how are they coping?
Fortunately, they have, for the tenants, they have leases in place. So their premium or their rent is pretty much fixed for a certain period of time. For now. But unfortunately for those tenants, the rents are increasing because that bill is being passed on, unfortunately, from the landlord or the owner of the property to the tenants. So instead, you see a lot of landlords reevaluating just to make sure that, hey, we're not losing out on money, because at the end, they're stuck with the bag and they have to pay for it. And they don't want to consume that cost.
Let's talk about the stock market for a minute. Let's sort of pivot to that area, because we're in the middle of the longest bear market run, I think, since 1972. And after these years of just tremendous growth, what do you advise your clients about getting into the market, getting out of the market, holding steady for now?
Like Paige alluded to earlier, it depends on every situation, right? And one thing that the stock market is experiencing for the first time in this last year that it hasn't experienced in the last 15 years is that there's competitive rates outside of the market. You don't need to go to the market to get a good return. You can go to a money market account and get 4%. You can go to corporate bonds and get 5%. The stock market has competition for the first time in 15 years. And so you saw a lot of that money leave the market to go to safer spaces. So the demand isn't there and the cheap money isn't there like it was before either. So right now at year to date, I think we're right around 1%, 0.5%, depending upon what index you follow. And it's been kind of a sideways market, and I'm anticipating a sideways market for the rest of the year. There might be a pullback, but I wouldn't expect anything too major, right? But this type of market definitely favors more a stock picker market, meaning that portfolio management where you can actually buy individual names and you can focus on good, strong companies rather than just following the indexes, following the S&P, following the Dow. At our firm, we tend to do individual stock portfolios, and it's kind of benefited us in the last year because we have been able to choose good, strong companies that we think are going to thrive in this environment, right? But yes, year looking out, I see a sideways market to continue. Volatility just back and forth.
Yeah, I completely agree. I would echo every sentiment that you said. And one thing we tell our clients is you're never going to time it perfectly, exactly. Right? If we could, we'd have a line out the door, right? If we could time it perfectly, getting into the market, I wouldn't wait for a big pullback in the market to enter. Right. And depending on the market, your portfolio is your how, right? But you have to figure out what the what is. What are you investing for? Is it for the purchase of a home? Is it a short-term investment? Because maybe now the market isn't the answer for that in the short term. Because of all of the other avenues for investing that are actually yielding return that they haven't been there for the past few years. So, but if your time horizon still is 5 to 10 years, if it is retirement, if it is for long-term growth, the market is still the viable option. Exactly. And it's just figuring out how to get in. And once you're in, what does that spread of assets look like for you? Right.
And to piggyback on that, if your long-term horizon is, if your horizon still is long-term, continue to dollar cost average, continue to put that cash to work, whether it be through the 401ks that work, the different employer sponsored plans. Because like you said, historically, the market has shown us that it is the place to be, right? So over the long term, still continue to put your cash there if that is your long-term horizon. But maybe if you have a short horizon where it's 1-2 years, then you start kind of looking around at different options. But like Paige said, if you do believe your horizon is 5-10 years plus, I would still continue to buy into the market today.
So when we talk about long-term, just since we have a few minutes to dig into this a little bit, let's just maybe get hypothetical. So when we're talking a long-term planning horizon, you say that's 5 to 10 years, or is that 20 or 30?
I would say 10 plus.
10 plus is long-term.
10 plus is long-term.
Mm-hmm. So if you have, say, somebody just starting out in their careers, let's say 30, just to make it nice, and they've got a little bit of money to start saving. Is the market a good place to be, or should they spread it around?
I think it depends upon, the goals of that money, right? So you have different, everyone has their own mental calculation of their money, right? So you have some of that money where it's your rainy day emergency savings money that I would not put into the market, right? Yeah. Maybe you have your retirement. So on the other end of the spectrum, you have your retirement money that into the market. And it's kind of that in-between money that it's, hey, this might go towards a big purchase 5 years out or 3 years out. That's the type of money where it's kind of like, what do you do with that? And right now, you really can't beat money markets or a CD or a bond or something like that. But if you are a little more a risk taker, then it is worth maybe going to the market, or, I think it's going to be a little bit more of a 5 years plus than maybe looking to the market. But anything shorter than maybe 1-2 years, I probably would take advantage of money markets or CDs right now.
And I think it depends on what options you have available to you as well. If you're working for a company that offers an employer-sponsored retirement plan and you're getting a tax break or tax deferral for contributing to that plan, if you're in the 22% tax bracket and you're saving 22 cents on that dollar by putting $1 in, the market can't guarantee that, but the IRS can through that vehicle. Right.
And the match is a guaranteed return right there as well. You have an employer match.
Absolutely. And so again, going back to evaluating that full financial picture and seeing what options do you have and what's the most efficient use for that dollar with those options.
And that's so important because I think probably younger people especially who maybe or don't make a whole lot of money with their salary. They're maybe reticent to set some aside, or they don't understand the value of a tax deferred plan. It's just so important.
It's so important. Take advantage of your employer match.
Employer match, and they say more time in the market is important as well too. So get in there as soon as possible, and the time horizon, right? So the more years that interest can compound, the more that money will grow.
Mm-hmm. What about people on a fixed income or people that are nearing retirement? What sort of advice would you give to them on the other end of the spectrum with respect specifically to getting into the market at this point?
I think, like Paige said, every situation is different. Some people are entering retirement, some may be considering entering retirement. Some people may not realize they can retire today, right? So one general rule of thumb that we use with prospective clients or current clients is the 35% rule. So if you're starting to think and consider retirement, it's the idea of, okay, what is my income streams currently? Maybe I have Social Security, maybe you have a company pension. Okay, now I have my investable assets, my portfolio. Okay, what is 3 to 5% of that portfolio? Whatever that annual withdrawal is, that's kind of, you put that above your guaranteed income stream, right? So one way to maybe back into what you need is to maybe look at your monthly annual expenses, take your Social Security, pension, those guaranteed income streams. If there's a difference between your expenses and the Social Security or the guaranteed income streams, you look at your portfolio, you do that 3%, 4, 5%. And if, let's say, 4% of that portfolio can meet that difference of where you need for your expenses, then you could probably walk away. That's a really easy little exercise that I think people can kind of go through and kind of figure out if it's time, if they're able to retire and have the willingness to retire, because that's 2 different things as well too.
Yes. And I think, and how you create your income and what you do with that income is so important too. If you are charitable, if you are wanting to help grandkids with school, if you're wanting to give to the next generation, looking at how to do that and do it in a tax efficient manner, how you give, you can give cash out of your pocket, you can donate directly from some of your retirement accounts at a certain age. And so evaluating not just what you're doing, but how you're doing it. Again, going back to the efficiency of that dollar, that can compound with tax savings and where you're getting those little dollars that you pick up, they add up over time, especially in retirement. And if you are on a fixed income, finding those right tax breaks can make a tremendous difference.
Right.
We'll come back to some of this in a few minutes, but I want to pivot for a minute to talk about what's going on in the banking sector, because that's been a huge economic story of late with some very significant and troubling regional bank failures. And we heard today from Jamie Dimon, JP Morgan Chase, that the crisis is over and there's no need to worry. But I think people are still worried. And I heard another report this morning about some of the other big regional banks that were showing that deposits were really coming out last month. Travis, the banker, do we have to worry? Should people be pulling money out?
So I don't think there's a real worry when it comes to your deposits, because at this time, those banks like Silicon Valley Bank, the way that they were structured and what they invested in, unfortunately, a lot of their liquidity was placed in one basket. And unfortunately, with the increase in rates, they lost a lot of money. So that was a huge contribution to the reason why they failed. The same with First Republic Bank. A lot of the way they're structured, and they pretty much catered to a lot of high net worth individuals, and it gave a lower rates than most banks. So when the rates increased, unfortunately, it wasn't making that margin to pretty much sustain as a financial institution. So, but only thing I can speak for is my institution. Yeah. We've been around for over 126 years. And with that being said, the way our deposits are structured is very granular. So we are well versed, and we have consumer and business. As a Hancock Whitney banker, and also to our clients, they have nothing to worry about. And I can say that with confidence.
And I have heard that from other bankers. But I mean, Hancock Whitney is not real, just on the cusp maybe of being a regional bank. It's more of a local bank, almost regional. I don't know where in the banking world you draw the line. But
so we're a large bank, but we still have that local feel. Yeah, we still have local decision makers. You know, we have right here on Porges, Hancock Whitney Center. We still have decisions that are made locally. So we are looked at as a large bank, but we still have local decision makers.
So you feel like the local banks, though, are pretty much protected from some of the factors that have really taken a toll on these regionals.
Again, I can't speak for all local banks. Only, you know, unfortunately, I can only speak for Hancock Whitney. But for us, the way our assets are structured, you know, we're pretty solid.
Are people concerned about it in your sector
Yes,
from what y'all
I
are
mean,
hearing?
we get questions from clients. And to piggyback on Travis, each one of the three bank failures that have occurred have all been poor risk management by those management teams, and they've been very much isolated to those individual businesses. And I would say if you're worried, we'll back up.
Yeah.
I think it's important to keep your money in regional banks. Regional banks support our communities. They have trickle down effects to sponsorships for your kids' teams, or big zoo to do. And,
Correct.
you know, it's important to keep your money supporting these local banks, not going to the big, well, obviously have some money if you'd like at a big national, international bank, but it is important not to pull those deposits from your local bank because those local banks do support our communities and do support our city. And it's important that we support them in return. And I would say if you are worried, is that there's FDIC insurance for a reason, right? And as long as your deposits are below $250,000, $500,000 for joint accounts, you really have nothing you should be worried about because your deposits will be insured. If your deposits exceed the FDIC insurance limits, maybe diversify your holdings to other banks to where you are covered within those FDIC insurance. And you can even begin to look into SPIC, which is investment brokerages that are insured up to $500,000. So that's another route to look into as well too. But I would say to keep your money in these local banks because it's important. They're in our community. They support us. We should support them.
And they're making some changes even to the FDIC to strengthen, I guess, the protections that people have, or to the program.
I know with some of the bank situations, the Fed came in and backstopped it and basically made FDIC insurance non-existent.
limit.
I mean, yeah, without limit. I mean,
Yeah.
it's there for a reason, right? But
Right.
the Fed came in and basically backstopped it is more or less what has occurred.
And I think to prevent future contagion, they
Right.
really stood behind. You know, every once in a while we hear, well, how can I trust that the federal government is going to insure my deposits? They showed it, right?
Yeah.
They showed it and then some. They didn't insure just up to 250 or 500,000 for a married couple. They insured all of the deposits. And so I think the recommendation is still there to diversify above that insurance limit. Don't count on that.
Yeah.
But the proof is in the pudding. They insured all of those dollars.
When we look at the economy locally overall, where are the pressure points that you're seeing and hearing from your clients and customers? Travis, what kind of factors are worrying people? What about like employment, for instance? I mean, I know the numbers are very strong. It would suggest that we have full employment, but I mean, I know there are still workforce challenges, and yet there are still people that seem to not be able to find a job.
I hear that. I hear that frequently. A lot of my clients will actually call me and say, how's business? They're saying business is great, but I just can't find anyone to actually fill any positions.
Yeah.
And I'm sure we can all
Yeah.
agree. And at this point, after COVID, you have a lot of folks that have went from working a 9-to-5 or a W-2 employment to starting their own business. But again, you have folks that are out here that's looking, you're trying to fill these positions, but their expectations or the candidates' expectations are super high, where they want these astronomical salaries, and some of them don't even qualify for these positions. Right. And I just heard this last week, maybe yesterday, from one of my customers, and he's saying business is great, but he has to turn away business because he doesn't have the employees to pretty much fill the gaps.
Wow.
So unfortunately, you hear about the unemployment rate, but there are a lot of places that are hiring. But again, the candidates' expectations are kind of like too high. But that all goes back to the rate rising environment that we're in currently. Everything is so costly and expensive, where they're subject to ask for these higher salaries. You know, they have to. So it's unfortunately it's like a never-ending battle that it's an uphill battle that we're facing.
Especially business owners,
Yeah.
right? So they're
Yeah.
getting pressured from both ends. Their costs are increasing, wages are increasing, and they're getting squeezed there in the middle where it's, which side do you get relief from?
Yeah.
And I think we're going to see sector specific. We're hearing, will there be a recession? Will there be a recession? And as long as employment as strong as it is right now, will we have a soft landing? Maybe. If unemployment doesn't rise by at least 0.5%. But we may see recessions within certain sectors of the market.
The rolling recession theory, right?
Yes.
So what is because that's what I was going to ask you is, are we going to see a recession? What is the rolling recession theory? What does that mean?
So if certain sectors like the tech sector, where we're seeing some of those big names lay off thousands of employees. So maybe Seattle may see a mini recession and people move and they come here to fill, maybe they're not going to work in technology anymore. They'll find a different sector to work in and they'll fill some of those vacancies. But they might have to take a lesser wage or a similar wage, but in a different sector. And how that all bleeds down to potentially other sectors, right? The hunt for jobs may be over. So that person who's asking for that higher wage is just eventually going to have to settle for less. And that is a big part of the Fed's mandate as well. And that's another avenue of that rate hiking is it does put pressure on employers, right? And so that is all to drive. We don't want anybody to lose a job, right? That's not the encouragement of the Fed. But from a macroeconomic standpoint, that is how you control the wage inflation spiral, which is the same idea. People need to make more to be able to pay for the increase in goods. So how do we slow that? And that all goes back to that hike in interest rates.
It's pretty incredible what that one interest rate and the trickle down effect has to the other interest rates, which then has to, the economy, which then has the businesses. I mean, it's crazy what that one tool that the Fed, well, not their only tool, but their main tool, what that one tool can do. It's crazy.
Yeah, no, that's a really good point. Let's talk about budgeting for a minute. For people, especially who are on a fixed income, and I think you alluded to this a minute ago, Mitchell, when you were talking about what people planning for retirement should be looking for. But how do you all advise clients in sort of the broadest way possible how to really manage what maybe little income they still have, given the volatility and uncertainty in the different areas we've been talking about? What are some of the basics of how they should be managing their money, their assets,
Right.
And especially with inflation.
You do have to say, right, every situation is different.
Yes.
Each client has different objectives, different goals, different financial situations. But I know for us, it's sitting down with them and it's providing them maybe with some tools and some cash flow charts where it's, hey, let's sit down and write down all of your expenses. And generally they don't like that. It's a pretty tedious task where they have to actually go through and write down all their expenses, right? And so that's typically step number one is, what are you spending your money on, right? Let's see that. And then it's providing them, once again, we have to provide them opinions on, hey, maybe you can curtail this, maybe you can curtail here. And it's just really just stepping down and really analyzing where you're spending your money. And if you're spending too much, so then you have to make more, right? So, and if you can't make more, then you need to spend less. I mean, it's one or the other is basically what it comes down to. It's not overly complicated. It's just actually sitting down and analyzing where you're spending your money.
Yes. And one of the positives of the rate hikes or the inflation that we're seeing is a lot of fixed incomes are tied to it, right? The cost of living adjustment that we're seeing for Social Security, even for tax brackets, people who were in the 22% tax bracket last year may have a nice surprise and be in the 12% marginal tax bracket this year. That's 10% relief. And looking at how Social Security has had generous hikes over the past 2 years because of that tie to inflation. So don't outspend your budget, but there are still positives with the interest rates going up as well, with that cost of living going up.
Do you have any advice, Travis, in that?
I couldn't have said it any better than Mitchell and Paige.
And I know we've been talking about rising prices and pressures, and certainly when you look at healthcare and healthcare costs and healthcare insurance, even if you're on Medicare or Medicaid, you might have supplemental. What should people be doing to prepare for maybe long-term healthcare needs and costs? What do you advise people to do with respect to that? And even younger people, should they be setting aside, like we talked about, tax deferred money to cover health insurance costs?
Healthcare costs are outrageous, and the that insurance market isn't here like it used to be even a decade ago. And it's gotten so exorbitant, those costs to insure major medical events, especially long-term healthcare. Again, going back to, and everyone is different and every situation is different, but don't ignore all of the assets on your balance sheet. If you have a paid off home, that is an asset. And hopefully you don't have to use that as an emergency asset, but reverse mortgage has a really ugly connotation, but a lot of rules and mechanisms have been put in place now. And again, this would be very situation specific, but looking at all of the assets on your balance sheet and how can you pull equity from a home or other individual assets without having to go and pay for that insurance.
Right.
Don't ignore other things that you wouldn't think, oh, it's not an insurance policy in my hands, but I have other flights to capital in that event.
You mean like borrowing against it, for instance?
Right.
Yeah, borrowing against, or if you have to go into a long-term healthcare facility, chances are you probably won't be living at your home anymore.
Right.
Don't forget the creation of funds, if you will, from that asset.
And, you know, for younger people, maybe taking advantage of HSA accounts, FSA accounts. If you're beginning to retire and consider Medicare, it's researching Medicare Advantage plans. The other thing, too, is I think people don't talk about enough is negotiate with the medical providers of the insurance company that and bring down some of those costs yourself, because a lot of those hospitals, they just want to get paid, right? So they will take something better than nothing. And there is different, negotiations you could do. You could set up payment plans. There is a lot of flexibility around that, but as Paige alluded to, it's still an expensive cost.
And with those HSA accounts, you can put money aside and it's tax deferred, correct?
Right.
Yes.
Okay, yeah. So, I mean, that's another option. And that's a huge option. So for those folks who are in that higher tax bracket, they can contribute, $5,000, $10,000 to an HSA account, and that can defer their income.
And I know, Travis, that some businesses are actually going self-insured.
Yes, a lot of business owners are self-insuring either for property or healthcare. I don't think that's the wisest for healthcare or living in South Louisiana for property. But hey, if you have the cash just laying around, I say go for it. If you're a healthy individual, but hopefully you won't break your arm because it's going to be very costly.
Right. It's hard for individuals to do it. But I think some of the companies locally, some of the bigger employers have gone self-insured because that's the only way they can really afford it.
Yeah. And again, it also depends on your employee base. So if you have, and I guess hopefully they will have someone looking at their employee base to see what's the average age and also to see how many they have. So to kind of do an analysis to see if it's actually in their best interest to self-insure compared to going out there and just getting a health care provider or insurance company to insure their employees for them.
I want to go back to the stock market for a minute. And Mitchell, you mentioned a little while ago that right now there are certain individual stocks that look more attractive than others. And I think for a while in the relatively recent past, the advice was EFTs or just funds in general that would spread it all out. But are you all advising differently now? And to follow that, which sectors specifically are really strong? If somebody does like to play around with the market, even if they just have a little bit of money to invest, which types of stocks would you think are maybe attractive?
Let me first off by saying this is not investment advice. My employer would like for me to say that. And number two, exchange traded funds, ETFs, mutual funds, those are all still great places to be. Exchange traded funds are, inexpensive, great exposure to the market. And there's absolutely nothing wrong with using those or mutual funds. And we do still strongly encourage, we still use those. But as far as when it comes to the market, as I alluded to earlier, it is a bit of a sideways market. But as of recently, taking advantage of some of this bank sell-off, right? You saw JP Morgan get sold down to levels that we haven't seen in a while, and it's taking advantage of that. And up until recently, it's taking advantage of some of these tech names that got sold off last year. because they still are very strong in large companies that aren't going away anytime soon, right? And then another sector we've been favoring is industrials, because right now we're about to see some big legislation come down the pipeline that's going to favor industrial type companies and also bringing some of that manufacturing back home, right? So you're going to see some of these bigger names like the Honeywells and the 3Ms and some of those types of names in that space that are going to benefit from this legislation and bringing manufacturing back to the States.
And I think the overarching theme there is where passive investing has had a tremendous amount of success
Yes,
since the financial
absolutely.
crisis. I mean, you could throw a dart on a board and see growth
Absolutely.
truly over the past decade and then some. We are not in the same environment that we were coming out of the financial crisis.
That's correct.
And so having active management, I think, is really going to lead the charge coming through this. When we have sideways markets and we're seeing a lot of volatility, a good money manager, a good diversifier of risk is going to pay dividends in this sort of environment.
That's correct. It's like after COVID, everyone became, a stock trader, and everything was going up during that time. And so everyone thought they were this very smart stock trader because everything was going up. Well, now it's not. So now you actually have to do your research and, like Paige said, diversify amongst a number of names, a number of industries, and really get into the details and kind of see what companies are going to thrive over the next few years, right?
Is there any amount of money or income level or asset level that's too small, like people who might be intimidated by the idea of a money manager or a wealth advisor and say, oh my God, I don't have wealth to be advised on. I can't, it's like me going to a fancy boutique. Like I don't shop designer clothes, right? I get totally intimidated. But should people feel that way? Or are you saying that it's really worth it? And
I can't tell you how many times I've heard people tell me that, family or friends, I don't have enough money to come talk to you. And it's like, actually you do, because it's good. It's good to at least get a second opinion. A lot of advisors will offer, a complimentary review. And maybe if they don't feel like you are in need of their services, they can provide you maybe with a one-time financial plan, or they can do some hourly work with you. It doesn't necessarily you have to put money with someone. There is other ways that an advisor will work with you. And sometimes that might just be an annual meeting where you sit down, you pay the advisor an annual fee or an hourly fee, and they look over your financials and they provide you advice and you move on. Other advisors, it is a continued relationship, right? And you do become a client of theirs where they're managing your money or providing you constant advice. I would say it never hurts at any walk in life to at least have a conversation with someone you trust. And if you are going to go speak with someone, ask around for referrals, do your own research, and maybe sit down with 2 or 3 different people and really see who you feel comfortable with and who you trust the most. Because you hear too many stories where someone gets referred to someone's neighbor's cousin that they know, and the neighbor's cousin sold them something that wasn't appropriate for them, right? So I would definitely say do your research, but absolutely sit down with someone. It never hurts.
Yes, and everyone's different. Our belief is that you shouldn't have to have $1 million to receive good advice. You may not need a single dollar at all to receive good advice. You may not have questions necessarily about the stock market or how to invest or all your money is tied up in your company's 401k. You still deserve good advice. And so to Mitchell's point, asking around and finding the right person who can maybe work hourly or on retainer to help you achieve those goals and should be able to provide some sort of value or even cover that cost through efficient tax saving advice or
debt management, or
debt,
maybe you don't have all the
whatever it
cash.
may be.
Maybe you're coming out of graduate school or medical school, law school, and you have a lot of debt, but it's how do I tackle this? Who can I talk to about this? There are some advisors that can help you with that and provide you that advice, even though, like you said, they don't have that $1 million in investable assets. They will. Some advisors will take you on because they see the potential in you as a client down the road, right? So it is worth having the conversation.
I'm not an investment banker, but I will say getting a second opinion or a third opinion, it's like going to the doctor.
Yeah.
You just don't stop at the first one who tells you, something's wrong. You get that second and third opinion just to make sure, hey, is this really my issue?
Right.
Or, to give that sound advice, like they were saying.
And you mentioned something, Mitchell, that triggered a question. Should people who might be confused about whether it's better to go to a stock broker, and sometimes you hear, well, no, because they're just pushing stocks, right? Or a wealth advisor or a money manager, a certified financial planner versus a chartered financial analyst. I mean, what really matters, and what designation should somebody, or just a
That is,
modest to middle class means be
right.
looking
No, and
for?
unfortunately in our industry, there is, actually my coworker and I were just talking this the other day. There's not a lot of uniformity when it comes to titles, and you could basically call yourself whatever you want. And unfortunately that confuses the end consumer, and the end client. But I would say, an easy place to start would probably be Certified Financial Planner. There's a website where you can go look for a directory and you can find certified financial planners in your area. Another one to look at, which would be Chartered Financial Analyst. Once again, you can find a directory online where you can find, advisors in your area that maybe hold some of these designations. And what those designations are essentially telling you is that, I've been properly educated in these fields. I have a very high ethics protocol with these designations, and I am educated to provide you with this advice. Unfortunately, in our field,
It's not always the case.
no, and it's like lawyers. You say you're an attorney. Well, what type of attorney are you? What type of lawyer are you? You really just have to talk to some advisors, and that's why it's worth talking to a couple, right? And you figure out, some all they do is manage money, some all they do is financial plan, but generally a lot will do both.
Yes.
And it's just finding the one that you feel you can trust and provide you the best advice.
And what you need. And I think a word that is somewhat getting overused in our industry, but it is still a really good question to ask is, are you a fiduciary,
Yes,
right? Can you put my needs above your own,
Yes.
coming from the client? And that is not always the case in our industry. And so making sure you ask that question.
And I would piggyback. There's a couple of other websites. There's FINRA's website and the SEC Investment Advisor website where you can go check advisors. It's called brokercheck.com or brokercheck.org. And then for non-brokers, investment advisors, you can go to the Investment Advisor website and you can Google these people's names and you can find their records. You can find out what licenses they hold. You can find out if they've ever had a client, complain about them, file charges against them. That is all out there.
Yeah, all
And
public information.
it's all public information. I would highly recommend go Google people's names and go research them because this information is out there. You can find it. And this is your money. This is your life savings. It's important to do that research.
You have to do your due diligence, ask the questions.
And Travis, I know a lot of the folks you work with are small businesses, and so a lot of what we've been talking about applies to them personally, but also their needs as business owners are maybe a little bit different. Small business, of course, is like the backbone of the economy. What advice do you have for them, and what are you seeing? What needs are really foremost in their minds?
So
right
with
now?
a lot of business owners, they're just looking at the immediate, like the short-term need. They don't really look at the investment piece at all. And we try to get that in their mind early on. Maybe setting up like a SEP account. Or, hey, you may have a 60-year-old business owner. They're not going to pretty much run the business for the rest of their life. They need to start looking for an exit plan. Right. And that's where these guys come involved. Getting them in front of the right investment advisor to say, hey, let's set up some type of plan or some path that you want to do this, or you want to pass it down. It could be as simple as passing it down to their heirs or their kids who's going to run the business going forward. So we try to get them to understand early on that, hey, you're not going to be here forever. So let's start thinking about either retirement or your exit plan, or, hey, you may just want to run it for the rest of your life, which God bless their soul. But that's where these guys again come in, and they're very vital to, the business owners' success and also their longevity and their livelihood going forward.
And the exit plan is so important. I've
sure.
covered so many companies over the years, small businesses, small companies that didn't do it until it was too late,
Right.
or really, it's critical, I think, for the success.
And I think the earlier you start planning, that's the better, because you can alter, you can really think about things and really get an understanding of, hey, this is what I ultimately want to do once I leave, or if I continue to work,
Right. Or how to structure it. And
correct, how to structure it, or say, hey, I don't want this kid involved, but I want this into it. You know,
It get messy.
you get
Small
all the
businesses
kinks
get
out
messy, man.
early, and that's why you put it on
Absolutely.
paper, right?
Right.
So you get those wills, you put it on paper, so you won't have your kids fighting once you're gone. Even though you're gone, you don't care, but you know.
You do. No,
That
Right,
is
right,
the
right.
attitude. Typically, it's I don't care. I won't be here.
I won't
right?
be here, right? And that's what you hear. You hear that all
Right.
the time. I won't be here. I don't care. But it's better to have it on paper and it can be solidified. So
And
there's no question.
It's never too early, and it's okay to change your mind too.
Right.
You can
Sure.
put it down on paper, and you're allowed to change your mind.
But the hard thing with those small business owners, it's sitting them down, right?
Yeah.
They are a mile a minute. They have 40 fires to put out a day, and it's actually, when they finally think about it, like 11, 12 o'clock at night when it hits
And
them.
that's when they call you.
Or that's when you get the email, and then you try to follow back up the
Yeah.
next day, and they're back fighting fires again, and they can't talk about it. And it's just pinning them down and talking about it.
So my mitigator to that is let's go to lunch. Everyone has to
Yes,
eat.
you're right. Everyone has to eat. You're right. You're absolutely
Everyone
right.
has to eat. So let's
You're
go to
absolutely
lunch.
right.
Let's really talk about it. And that's the time they can kind of decompress a little bit and
Exactly.
really take it in before they get their next call.
That is a great idea, the lunch.
Yeah.
They got to eat.
What about our gig economy workers? There are so many, and I think the number's probably growing. It's a relatively new thing, but we have more and more gig economy workers who maybe, I was just thinking about it when you were saying they're answering emails at midnight or sending emails at midnight, and they don't maybe have the structure of a company with a 401k plan or a health plan. Is there a special category of advice or recommendations for people who are maybe driving for Uber and, working part-time as a wage earner, doing something, and I don't know, playing in lots of different sandboxes just to try to make ends meet?
Well, you have a lot of opportunity as soon as you go into that gig work, that 1099 income. You have so much at your disposal, if you will, from a planning perspective. You can write off your expenses. You can
Right.
set up your own retirement account,
Yep.
whether that be a solo 401k, a SEP IRA. And if these words are overwhelming, that's probably your sign that you need to sit down and talk with somebody, because it's not as easy as filing your own taxes anymore or making your own, I'm just going to send 10% to my 401k. You probably need a little bit more hands-on advice once you cross over into that realm and you're feeling comfortable with your income. Reach out to somebody, because there is so much at your disposal and that you're probably not taking advantage of from a tax savings perspective, from a retirement savings perspective. There's so much.
I think Paige hit the nail on the head, and it's comparable to a sole proprietor lawyer or sole proprietor
Yes.
CPA. Similar to those type of businesses. They're these 1099 employees, and they could take advantage of a lot of different tax breaks and retirement plans, especially that you can
Yes.
really put a lot of cash to work in.
And what about people who are coming out? You mentioned them a minute ago, Mitchell, with a lot of debt, student debt, law school debt, college debt, whatever. Any programs or advice that are specifically tailored to help them pay that down?
Yes. And I think it depends upon what type of debt they hold and where they are. If you're still in school, you can access the student loans and consolidate them all and run it out 30 years, right? But I would say it's talk to an advisor. They have debt specialists out there as well, where they can help you consolidate that debt. And I think with debt, the biggest thing is reduce that principal as much as possible and find the best rate. And then continue shopping it, right? Continue looking around. And as rates hopefully begin to drop here in the future, reshop it, get a new loan. I would say that's probably the biggest advice is shop it and look around.
And have a plan for payoff. Don't blindly throw money at just any given debt. Prioritize that interest rate. Prioritize how you're paying off that debt. And that's
It's not just, don't treat us tomorrow's problem. Treat us
it is
today's
today,
problem.
yeah.
And I think that's the most vital, is prioritizing and saying,
Yes.
hey, this is 22%. Let me work on paying this off first compared
Right.
to the 6% that I have here on a credit card for only $2,000.
Yes.
Right.
So,
yes.
that's super important.
And you probably see a lot of that, Travis, people
Yes.
coming in with a lot of debt and helping
Yes.
them restructure that.
And that's why, going back to the home equity line of credit, it's tapping into whatever
Yes.
assets that they have where they can start consolidating. That's important. Again, with consolidating, it's as simple as just going into the bank. A lot of folks don't know that they have options. But again, staying in front of your banker, your advisor, or your insurance agent, staying in front of them, have that open line of communication, so you'll know that there are options out there. There are other options.
Yes.
Well, we're almost out of time, guys. I'm not sure when exactly we're going to cut off, but just super quick. Any last words? You feeling good? Good about the next 6 to 12 months? Mitchell?
Hopeful.
We're
I'm
hopeful.
Yes,
I'm
hopeful. Yes, I think that's a good way to
Good
put it.
word.
I think you're hopeful. You have trust. Historically, we have shown that we're going to come out of these type of periods, and there will be a light at the end of the tunnel. There will be greener pastures on the other side.
Yes.
Paige?
I agree. I'm hopeful. I know there's a lot of uncertainty, but a lot of that uncertainty is behind us. And so don't let that weigh you down. There's greener pastures ahead. Absolutely.
We live in the greatest country in the world. So at the end of the day, you know, we display a lot of resilience, and I'm more than certain this show, we shall overcome this as well, just as we've done other obstacles in the past. So let history prevail.
3 years ago at this time, we were all in lockdown, right?
That's right.
Right,
Look at
there you
us
go.
now, and so here we are. Well, Mitchell Bordelon, Paige St. Martin, and Travis Moore, thank you all so much for being
you.
here
My
with
pleasure.
us today. This has been such a really interesting and informative discussion, and y'all have shed a lot of light on some very important topics that I know have helped educate me and hopefully helped educate all of you out there. Thank you so much for joining us this morning. I hope we've answered some of your questions. Thanks to our sponsor, AARP. I'm Stephanie Regal with the Times-Picayune, NOLA.com. We appreciate your support and hope you will continue to enjoy reading us and subscribing us. Have a great day.